Well, are we sitting on borrowed time? Today we're going to take a look. Stay tuned for Prudent Money. Good afternoon. This is Bob Brooks, and you are listening to the Prudent Money Radio Show. Thanks so much for joining me today. You know I do appreciate it. I want to make sure that you know that there is a site you can go to, which is prudentmoney.com, and ask a question. If you got one, ask a question about risk, ask a question about your 401k, your IRA, whatever is on your mind. Just to use it as a resource. It's the Ask Bob section at the top of the page. Just click through, and there's you'll see where to put in your information on your question. We'll get back to you that day or the next day. So I'm very serious about that. Want to make sure that you know that's a resource that is available to you. That's all at prudentmoney.com. Also, while you're there at the site, sign up for the Prudent Money e-letter. That's a great way to stay connected, and as we do notify you every time we put something out there, and it's a great resource for you as well. Let's talk a little bit about a question that I'm getting a lot of, and it's about the condition of the market. And I used to do workshops a lot, and I would do them on second or third Saturday at the beginning of each year. And one of the things that I always did, I would start out the workshop with, okay, let's take a look at what this year's risk looks like. What we could be facing over the next 12 months. And it just so happened the day before I had heard, this is in 2020, I had heard a newscast and someone had mentioned the COVID virus. And wasn't anything that was really widely reported story, but did hear that, and I thought, you never know, something like that could break out. I put it on the list, and lo and behold, it broke out. Not because I put it on the list, because that was just a lucky guess, but that it's all the things you don't see coming that are the big risks. And with the situation with 2020, what it looks like at that point, we had no idea and no way of predicting that. But it turned out, of course, as you know the story and the way it happened, what turned out, and became of it, not to even mention or fail to mention the people who died of COVID, and what a sad story that was. But 2020 was, even to think back to that year, and as you think about being at home, and it was like everything just kind of stood place, time just stood still. Well, last week, I don't know if you saw this, I always watch extended weather coverage because it interests me. But Pete Delkus on WFAA, they were doing extended weather coverage of some of the tornado activity that was coming through, and the storm systems that were coming through Texas, and especially the DFW area. And he said something very interesting, and I thought that really does apply to the stock market in such a big way. And he was looking at a live picture and saw this storm moving its way, going in a southern direction. I can't remember what city. It was over there near Weatherford, and maybe Palo Pinto or something like that. And he was talking about all the different things that this chart was showing. And of course, it was very red and looked ominous. If you just really looked close enough to it. And he said, the way that the characteristics of this chart and this pattern and everything that I'm seeing leads me to believe that there is a tornado on the ground. You couldn't see it, you couldn't see the rotation, but it was because of all these elements were coming together that at any time you saw that, just about 100% of the time, there was a tornado on the ground. And I thought to myself, all the things that are happening right now, all the risk that's out there, that's kind of the same situation. That every time we see these things occur. And we don't necessarily see the financial tornado, but it's there in the background, and it shows up in a form that we just didn't see coming. And I think that is what the overall biggest risk is that. Having said that, I want to also say that probably the greatest opportunity that you have as an investor is to preserve money during those times. And I know it's the ideal situation, and you're welcome to think, oh, it can't be done. Bob's talking about timing again. No, I'm not talking about timing. And we're not even going to go there. What I'm talking about, though, is the ability to preserve your assets, and that comment covers a lot of different situations. But preserve your assets and be able to reinvest at the point that stocks are at the end of their bear market run. Bear markets are something that are alive and well. They haven't gone away. It's just a situation where we haven't seen one in a very, very long time. I think we're very overdue. Doesn't mean it's going to happen, but you see all those charts, and they're on the weather map, and they look, like I said, they look very bad, and they look like a storm that's really about to do a lot of damage. And then they turn into, if we were talking about the stock market, because you see a lot of charts, a lot of different things on a stock market chart, and they look at the stock market and they say, there's just volatility. The market went down, say 8% that day or 5% the day before. It's just volatility. It'll go away. And so they look at it from the standpoint of, just because it's volatility doesn't mean you need to be alarmed. And this is true. I mean, I think you have to be able to give the stock market space to do its thing. And if it's working through some volatility, it's working through some volatility, and it'll get better. But you can't always count on that, because sometimes volatility is a forecast of a change in market direction, which is a bear market, which you've got to be very, very careful about. And once again, all the elements, just like volatility, are there. It's just that you can't predict it. Just like you can't predict things and perfectly time the market around them either. That's why I'm not talking about timing the market. If you ever make any changes, remember, we're talking about, if you have your portfolio, you're looking at the risk level and you're saying it's too much risk, and you take, say you reduce the risk by a certain amount by doing different things, that is a risk management type scenario. It's not timing. But we can talk about that another time. So we're looking at this and just wondering, really what is ahead. And I think that you have to do an analysis and really take a close look at what is happening. If I were to do an analysis, and the whole purpose behind going through this exercise is to come up with a probability that the market's going to run into a problem. And so we start out, of course, I can't deny inflation. What's interesting to me, and I'll mention talk a little bit about this later. What's interesting to me, though, is that inflation, definitely a problem. Gas prices, of course, that's the obvious part of it. Food is another part of it. And, going out to restaurants. When you're looking at across the board, they said there's a 3% inflation rate when various stores are going up 15-20%. I mean, you definitely feel that the difference. And what's interesting to me about the grocery store is that you go in there, everything looks very innocent. I was looking at the ice drinks. I don't know if you ever drink the ice drinks, but my family loves the ice drinks. And generally speaking, they're $1 a piece. And I went to the grocery store last weekend and got a few and picked a few up. And I noticed that they had them on sale for $1.50 off of $1.75. And I thought, that's not on sale, because $1 used to be somewhat of the regular price. And I don't think, and $1.75 might be their max price. I don't know, but they're definitely not on sale. But it came down to $1.50. That's a 50% increase. No, it's a 50% increase off of $1.50. You get enough of those increases in overall inflation, and you are going to spend way more than you thought that you were going to spend in the grocery store. It's just the way it goes. But gas prices, food, I mean, just about everything is starting to get hit by inflation. And there's a lot riding on whether or not this inflation is going to be something. We'll have to see how this all pans out, obviously. I mean, I think that the most interesting thing to me from someone who watches this all the time is that if you look at what's really happening versus what the economic indicators are saying that's happening, is two different worlds. I mean, in reality, people are feeling the effects of inflation, and it's tough. I mean, you just watch the news. People tell their stories of how they're foregoing this, foregoing that, just to make sure they are able to put gas in their car. And so, I mean, it's a tough situation. I heard in Cuba that the gas was $40 a gallon. Tough to believe, but $40 a gallon. Hopefully not coming to a gas station near us anytime soon. So we'll have to watch and see, how that pans out. But definitely a factor on the list. Then you got the economy, same type of deal. I think the economy is in a lot worse shape than what the indicators are showing. Unemployment is not definitely if you look at other facts and figures, is starting to show up. So you got all these things that are one reality versus another reality. Hey, this is Bob Brooks, and you are listening to the Prudent Money Radio Show. We're up against a break. Stick around. I'll be right back. Hello, this is Bob Brooks. Proverbs 22:3 and Proverbs 27:12 are the exact same verse word for word. I call them the stewardship verses of risk. A prudent person foresees danger and takes precautions. The simpleton goes blindly on and suffers the consequences. On the Prudent Money Radio Show, we teach about risk, how to identify it, how to figure it out, and what to do about it. We believe that to be a prudent steward, you have to be a good risk manager. Listen to the Prudent Money Radio Show on Bible School Radio 91.3. Prudent Money, home of the modern-day steward movement.
Dynamic, practical, life-changing.
There's no point in going to church and not letting the Christ who gave birth to the church on the day of Pentecost change your life.
Join us each day as Pastor Paul Shepherd applies the timeless truth of Scripture to everyday life. It's Destined for Victory on this great station.
Weekday afternoons at 3:30 here on Bible School Radio, KDKR.
This is Rob Randall, your host and teacher of the Invisible War radio program. The Invisible War is the study of God's Word on how to walk in Christ's victory in the spiritual battles we face against the powers of darkness. Join me every Sunday morning at 9 right here on KDKR and KYJC in Commerce, your station for life.
This is Bob Brooks, and you are listening to the Prudent Money Radio Show. Thanks so much for joining me today. You know I do appreciate it. If you got a question for me, go to the website, www.prudentmoney.com. Go up to the top page. There's a link that says Ask Bob. Just click through. We'll get you taken care of. That's all at the website. Also, make sure that you sign up for the Prudent Money e-letter. We send information out. Want to make sure that you know about that. That's all at the website, prudentmoney.com. And let's see, what else would be on the list? We're talking about a list of things we need to keep an eye on, a list of various scenarios that spell risk for your retirement money, assuming that's what you're investing for. Most people are. And, of course, there is the war with Iran is a very serious subject, something that we saw today, some of the risk kick back up. And as shots were fired, of course, they're leaning on a ceasefire agreement. As we talked about I don't know, 8-10 days ago, whenever it came out. To begin with, those rarely work, and it always ends up kind of like this one is. So we'll see what happens there. The other is stock valuations. All that means is that investors are paying way more for stock in different companies than they're actually worth. That always precedes a fall in the stock market. What's interesting, though, is that also, if you look at the valuations, and you got to really kind of think through this, but it's a pretty big statistic, is that when the stock market, individual stocks are this highly valued, and today they are they're at record levels. The next however many years is not really a great time to be in the stock market. We'll see what happens, but it is something good to know. The last thing that I'll mention is the Federal Reserve Board, and why I would bring them up is because you're going to see a switch from Kevin Warsh, I think that's how you say his last name, to Federal Reserve Board, Federal Reserve Chairman, Jay Powell is the outgoing Fed chair, and Kevin Warsh is the incoming Fed chair. And there's a lot of risk to that happening, because the new Fed chairman is very big buddies with Trump. In fact, Trump made the comment today, and this is, there's supposed to be a wall of separation between the Federal Reserve Board and the White House, and because they're the most powerful agency probably in the planet, and they have access to great tools with the money, being able to increase or decrease the money supply, being able to control inflation, the economy, and they're very, very, very powerful. Well, you certainly do not want any president to be able to have access to that power. It's just not a good thing. And so President Trump today said that since the Federal Reserve building is not finished, they did a bunch of renovations on it, that the new Fed chair should office right down the hall from him, or something to that degree. Not a good thing. Sometimes I wonder if he just says these things just to get a rise, but unfortunately I think he's serious. So that definitely goes on my list. He said, it's Kevin Warsh. He said, we'll have an office next to me in the White House because the Fed building won't be done. I would like to think that nobody will let that happen, but you never know. But that would be my long list of concerns. Now, if I look at that long list, what kind of a probability do you assign to it? I would suggest it's a higher probability of over 80%, but we'll see. We could be having this conversation a year from now and wonder why the market didn't drop, didn't have a decline. And at some point, the economy just can't handle it anymore and kind of implodes. We'll see what happens. Once again, I think that if I were saying my case in court, I would have a very convincing argument. It doesn't mean I'm right, but it is something that you definitely want to, and we talk about this all the time. I know it's like a broken record, but I'll say it again. From a stewardship standpoint, you want to double check and make sure you're comfortable with the risks that you're taking. So just keep that in mind. The next question that comes up is, what is the best combination of investments that a smaller investor can put together to ride out a possible storm? I was thinking a lot about this, and of course, thinking about this a lot over the past year or so, when things have just seemed so very out of balance. And, really what you have is two different types of investments. You have you have bonds and you've got stocks. And that's why I believe, and not the way that the White House is suggesting it be done, because I don't believe you want to bring, that's a whole other story we won't get into, but I don't think private equity is the answer. And I wrote a piece on that. It's at PurdueMoney.com if you want to go check it out. But I just don't think that that's the answer. I think that is the wrong move. But I do think that 401k plans need some alternative type investments to go along with bonds and stocks. But at this point, and especially since bonds have been poor returning, except for the last couple of years, but they've lost quite a bit of money if you look over the past 5 to 10 years. If you just have bonds and stocks to provide yourself a diversified portfolio, then a certain portion is going to go in bonds, a certain portion is going to go in stocks, and of course you could use whatever to represent a bond allocation in your portfolio, and you could use whatever to represent a stock allocation in your portfolio. This is not recommended as investment advice. Something like the S&P 500 index fund that represents the stock market is typically a good stock type index, and you can look for the same type of bond type index. You're looking at, when I think of dividing those into two different types of portfolios, I think 75-25, 50-50, then 25-75, and then 100%. So you could go 100% stock, 100% in stocks. Then you could go 75 in stocks, 25% in bonds, 50% in bonds, 50% in stocks. You get the idea. And it moves down to zero, goes from 0 to 100%. And of course, I mean, in my mind, that's really all the advantages that you have, unless you take advantage of, as far as bonds go, you're supposed to get some diversification from bonds, but just like in 2022, both bonds and stocks lost a lot of money. And in 2022, you saw a loss of around 18%. And, the good thing about bonds is that when they go through, and this has just been historic, you can look at the track record, when they go through a very, very bad spill, they typically make fairly decent conservative returns going forward. The one caution that you want to keep in mind when it comes to bonds is that a rising interest rate environment is still not good for bond prices, and so that's what you want to keep in mind. And the fact that if the Fed does their job, which with this relationship between Trump and Kevin Warsh, the new Fed chair, we'll see. I mean, President Trump desperately wants to lower interest rates, which I think is a very, very bad move. And I think that especially with the strong of inflation as we've got in this country, you don't necessarily want to do that. Of course, I'm not the Fed chair either, and nobody's asked me to be in line for it. But that's just my own opinion. We'll go on. But as far as bond funds go, you could use something like a short-term Treasury fund, type of bond fund, if you have one available. It's been my experience that there's really not a very good options when it comes to selecting a bond fund. There's all kinds of options for stock funds, but stocks taking the most risk. So that there's the trouble, the issue that you run into with bonds. The other thing that you can do if you're out, there's a lot of things you can do if you're outside of a 401k. And incidentally, if you're over the age of 59 and a half, most, obviously, high 90 percentile companies will allow you to move that money from your current 401k plan over to a 401k plan that you can manage yourself or get someone to manage for you. And that's definitely, if you have that opportunity and you have the bulk of your money sitting in that 401k, I think it's a great alternative to just giving what you're and taking advantage of what you have. But we'll talk more about that tomorrow. We're ending up wrapping up the program as I look at the clock. If you have any questions for me, just go to the website. I know a lot of this is it's tough to take in on a Monday afternoon, but just keep it in mind. These are things we need to make sure that we know what steps we're going to take. And tomorrow we'll finish talking about that and to talk about some of the other things I've got on the list. Always have a lot to talk about, lots going on. So we'll cover all that tomorrow. In the meantime, send me a question if you got one. I'd love to take care of that for you. This is Bob Brooks, and you are listening to the Prudent Money Radio Show. Thank you so much for joining me today. You know I do appreciate it. If you got a question for me, please go to the website, www.prudentmoney.com, and just send it in, because we are all out of time. Till we do meet again next time, keep the faith and have a great rest of the day.
That's all the time we have for today. Questions or comments for Bob, or to find out more great information like what you've just heard, visit www.prudentmoney.com. Be sure to join Bob Brooks again for the next edition of Prudent Money.